as of December 31st, 2025. The U.S. equity market stands at a point of extreme imbalance rarely witnessed in financial history. 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla collectively represent approximately $14.2 trillion in market capitalization, accounting for over 32% of the total value of the S&P 500, an index whose aggregate market cap sits near $44.3 trillion. In effect, nearly one-third of what investors believe to be a diversified portfolio is concentrated in just 7 names. This level of concentration is unprecedented. It surpasses the railroad and steel trusts of the early 20th century. It exceeds the dominance of the Nifty 50 in the early 1970s. It eclipses even the peak of the .com bubble in 1999. At no point in over a century of recorded market history has such a large proportion of total market value been assigned to so few corporations. But concentration alone is not the true danger. The real threat lies in the valuations attached to that concentration and the growth assumptions embedded within them. The Magnificent Seven trade at an average price-to-earnings ratio of approximately nearly double the long-term historical average for dominant market leaders, which typically ranges between 18 and 22 for these valuations to be justified. Earnings must grow at roughly 25% annually for 5 consecutive years. This is not a speculative estimate, it is a mathematical requirement. Yet the reality of these businesses tells a very different story. These are no longer early-stage disruptors expanding into untapped markets. They are mature global corporations operating at scale, constrained by saturation, regulation, competition, and diminishing marginal returns. Growth is slowing measurably, consistently, and across nearly every segment. Apple's iPhone sales, which account for over half of its revenue, have plateaued and begun to decline. Microsoft's cloud growth, once expanding at rates exceeding 50%, has decelerated sharply. Nvidia faces permanent structural limits due to export restrictions and intensifying competition. Amazon's cloud business is maturing while its retail margins remain under constant pressure. Alphabet's advertising model is increasingly threatened by generative AI. Meta's engagement growth is shifting toward formats that generate less revenue per user, while its metaverse investments continue to consume billions. Tesla, valued as a revolutionary technology firm, increasingly behaves like a cyclical automaker competing in a crowded global market. When growth slows, valuation multiples compress. This is not ideology, it is arithmetic. If the average multiple across the Magnificent Seven contracts from 42 to just 28, still well above historical norms, approximately $7 trillion in market capitalization disappears. If valuations revert closer to long-term averages, total destruction exceeds $9 trillion. Because these companies dominate index weighting, their decline mechanically pulls the broader market lower. Under such conditions, a 45 to 50% decline in the S&P 500 is not an extreme scenario. It is a rational outcome. What makes this cycle uniquely dangerous is the mechanism that inflated it: passive investing. Over $11 trillion is now allocated to passive index funds and ETFs, tied to the S&P 500. These vehicles allocate capital based solely on market capitalization, not valuation, growth prospects, or business quality. The larger a company becomes, the more capital it automatically receives. The more capital it receives, the larger it becomes. This creates a self-reinforcing feedback loop that drives prices higher independent of fundamentals. On the way up, this system appears efficient and risk-free. On the way down, it becomes brutally when investors redeem shares from index funds, the funds must sell holdings proportionally because the Magnificent Seven represent 32% of the index. They absorb 32% of every dollar of forced selling. Falling prices reduce market caps, which reduce index weights but not fast enough to prevent continued selling. The mechanism feeds on itself. Selling begets lower prices. Lower prices beget more selling. This is not discretionary behavior. It is mechanical. And it does not stop with passive flows. Rising volatility triggers risk parity funds to reduce equity exposure automatically. Options market makers hedge declining call positions by selling underlying shares, accelerating downside pressure. Momentum strategies reverse from long to short when technical levels break. Leveraged investors face margin calls. Each layer activates the next. Fundamentals become irrelevant in the face of forced liquidation. This pattern is not theoretical. It has played out repeatedly throughout history. The most instructive parallel is the Nifty 50 bubble of the early 1970s. At that time, institutional investors concentrated capital in roughly 50 dominant U.S. corporations believed to be one-decision stocks companies so superior that valuation no longer mattered. These firms traded at extreme multiples, often exceeding 40, 60, or even 90 times earnings. Investors justified these prices by arguing that growth would persist indefinitely. When inflation surged, interest rates rose, and earnings growth slowed, the illusion collapsed. Between 1972 and 1974, the Nifty 50 declined 64% on average, with many stocks losing 80 to 90% of their value, despite the underlying businesses surviving. Coca-Cola, Disney, IBM exceptional companies still required over a decade to recover prior highs. The lesson was unmistakable. Paying extreme prices for great companies produces catastrophic outcomes when growth slows. Today's environment is more fragile. Passive investing is vastly larger. Valuations are higher. Concentration is tighter. The unwind, therefore, will be faster and more violent as earnings reports in early 2026 confirm decelerating growth. Initial declines will push volatility higher. Volatility triggers deleveraging. Deleveraging triggers forced selling. Forced selling pushes prices lower, which further raises volatility. This feedback loop transforms disappointment into panic and panic into cascade. By the time selling pressure exhausts itself, trillions in paper wealth will have vanished. Retirement accounts, pension funds, and 401(k)s believed to be diversified will suffer losses not because investors made reckless bets, but because they unknowingly concentrated risk in the most overvalued stocks in market history. The idea that passive investing eliminates risk will be exposed as a dangerous misconception. Passive investing does not remove risk. It redistributes it quietly, mechanically, and invisibly until it becomes systemic. The survivors of this unwinding will not be those who believed this time is different. They will be those who understood valuation discipline, diversification across asset classes, and historical precedent. Those who recognized that bubbles are defined not by excitement, but by concentration. Those who accepted that missing the final stage of a rally is far less damaging than enduring the full collapse. This is not a call to panic. It is a call to clarity. The collapse of the Magnificent Seven is not speculation. It is the logical consequence of extreme concentration, unsustainable valuation, slowing growth, and mechanical market structures that amplify both upside and downside. When expectations collide with reality, markets do not negotiate. Numbers enforce adjustment. The only remaining question is not whether this repricing occurs, but who recognizes it before forced selling makes choice irrelevant.